As my dad used to say, we are in deep, dark, dirty water. So each week that goes by, more and more news and data are pouring out about the housing market and about the economy, about how things are slowing down, and all the indicators that we're seeing across the financial world economically are all negative in general for the country as well as for housing. So in this video, we are going to dive in. We're going to take a look at a lot of this news and information and talk about how it's affecting the housing market now and how it's likely going to continue to affect the housing market going forward. So stay tuned and let's jump right in. So the first thing I want to talk about here is mortgage rates. And unfortunately, no matter what the government or the Fed tries to do to bring interest rates down, they just keep going up. So as you can see here, over the last couple weeks, we've seen mortgage rates start to rise again. And this is not a good sign. Pretty much across the board, we are seeing hesitancy to buy US debt. We're seeing market participants in the debt space demanding higher interest rates, not lower interest rates. It's starting to look like the Federal Reserve is losing control, and this can become very, very bad. We could ultimately face higher interest rates for way longer than anybody's expected. And I've been talking about that on this channel for quite a while, despite a lot of people saying that interest rates are going to go down. So if you look here, we see that interest rates are up about 6.8% right now, and they'll go down for a week or two, and then all of a sudden they'll spike higher for one reason or another. Even after Trump decided to significantly reduce the tariffs, we saw a little bit of a decline in rates, and then all of a sudden here we are again, and they're climbing again. So this is going to be a major headwind going forward for housing in the US. The next thing I want to share with you that is an ominous sign for the economy in the US right now is the dollar index. And you'll see the dollar index is currently trading here at 99.17. It looks like it might break down pretty soon below this kind of threshold that we hit just below 98 recently. And that would be a very, very bad thing, because that means that foreign investors who are investing in US denominated assets continue to lose money by holding these assets. And if they're going to do that as time goes on, they're going to demand higher interest rates as compensation for this risk. Now you can see here, just going back, not even 3 months ago, we had the dollar index trading at 110, and now just a few months later, we're down to 99. So that's more than a 10% drop in the value of the dollar compared to the basket of currencies that makes up the dollar index in just 3 months. That is not good, and that is going to cause a lot of pressure upward on interest rates moving forward. Next, let's take a look at some data coming out of Redfin just recently that also points to some serious headwinds and some serious declines in the housing situation. And here the title reads, US home purchases were canceled at the second highest April rate on record. Now, moving a little further into this report, we see roughly 56,000 US home purchase agreements were canceled in April, equal to 14.3% of the homes that went under contract that month. That's up from 13.5% a year earlier and is the highest April share in records dating back to 2017, with the exception of April 2020, when the coronavirus brought the housing market to a halt. Home buyers are skittish for several reasons. Economic uncertainty. Redfin agents report that some buyers are getting cold feet due to the widespread economic and political uncertainty. Tariffs, layoffs, and federal policy changes are among the factors prompting people to stay put instead of move. It's a buyer's market. Housing inventory is at a 5-year high, and demand is slowing, meaning the buyers who are in the market often have room to negotiate. Some house hunters are backing out during the inspection period because a better house has or might come along. Sticker shock. Mortgage rates and home prices remain stubbornly high, with April's average rate hitting 6.73%. More than double the pandemic record low. Combined with economic uncertainty, high housing costs are causing some would-be buyers to change their minds at the 11th hour. And another article recently out of Redfin, new listings hit highest level in nearly 3 years. Would-be buyers are sidelined by record high housing costs and economic instability, allowing inventory to pile up. Now, I just want to take a minute and say that when you see these major national real estate brokerage companies like Redfin and Zillow talking about housing price declines, talking about slowing down in the market. This means that this is really serious because these companies generally try to paint as rosy of a picture as they can, in my experience. And pretty much all of them now are saying that things are slowing down. Interest rates are going up, buyers are holding off on purchasing, inventory is starting to really build in many markets, and prices are falling in many markets across the country as well. So jumping back in, new listings of US home sales for sale rose 8.4% year over year to their highest level in nearly 3 years during the 4 weeks ending May 18th. But buyers aren't biting. Pending sales fell 2.2%, dropping to their lowest level for this time of year in our records, which date back to 2015, and mortgage purchase applications are down 5% week over week. The uptick in listings and decline in sales are causing inventory to pile up. The total number of homes for sale rose 14.3% year over year to their highest level in nearly 5 years. You heard that right. The total number of homes for sale rose 14.3% year over year to their highest level in nearly 5 years. And I want to say here that I get a lot of comments where people think that I'm making this stuff up or the housing market's doing great. And that's just not the reality. In fact, I think a lot of sellers are still somewhat delusional in thinking that they're going to get 2022 prices for their home when we're in a totally different environment than we were back then, with these much higher interest rates, a lot more economic uncertainty, and a lot of very hesitant buyers out there that really can't afford the high prices and the high interest rates combined. And here, lastly, fewer Americans are buying homes because it's more expensive to buy than it's ever been. And economic unease is making people nervous about making such a big purchase. The monthly median housing payment hit an all-time high of $2,882 with a 1.7% year-over-year increase in home prices and near 7% mortgage rates contributing to high costs. Many of the people who can afford to buy are hesitant to do so, with consumer sentiment sitting at near record low amid fears of a trade war and potential recession. So guys, I just want to say really quickly that if you're a seller in this market, you have to be realistic. You have to realize that you're competing with a lot of other sellers and a lot of homes that are just sitting on the market and that are ultimately likely not going to sell unless that seller decides to lower their price enough to get their home sold. So you don't want to be one of the sellers that has one of the highest prices compared to the other similar homes like yours. You want to be one of the sellers that has one of the lower prices that's going to attract a buyer and get them to buy your house instead of the competition. Next, let's take a look at what's happening to demand for US Treasuries. And this is also another bad sign. And this is another reason why interest rates are rising for bonds or in the Treasury market, because we're seeing weak foreign demand. Less and less foreigners are wanting to buy US debt because they know the debt is skyrocketing and there's no end in sight. Tepid demand for US Treasury auctions shows investor jitters about tax bill and the deficit. Obviously, the government is working on passing the big beautiful bill, which should be called the big ugly bill. And we're going to talk more about that in a minute. But this is a very, very bad sign for the US economy. This signals massive increases in debt and deficit spending as far as the eye can see. And these are going to be huge problems that we're going to face as a country. And also, this is going to cause interest rates to most likely remain much higher for much longer than everybody anticipates. And as we see here, some of the summary headlines here: Treasury sees soft demand for 20-year bond auction. Investors concerned about fiscal inflation outlook. Well, duh. Treasury yields rise after auction. 20-year yields highest since November 2023. Again, this is not good news, guys. And by the way, if you want to take a look at any of these articles, I'll go ahead and post all of them down in the description below. Real quick, I just want to take a look at this big ugly bill that they're working on passing and just talk about what this looks like for the future in terms of deficit spending and how bad this is really going to be for the country. In a future crisis, Congress may not have as much firepower to come to the rescue because the government is already saddled with $36 trillion of debt. The nonpartisan Congressional Budget Office estimates that President Donald Trump's big ugly bill would pile another $3.8 trillion to the mountain of debt. That kind of extra borrowing would only amplify growing concerns about America's unsustainable financial trajectory. The US is heading in the wrong direction. This bill would be one more nail in the coffin of a country falling under an enormous debt burden, said Christina Hooper, chief market strategist at Man Group, the world's largest listed hedge fund. This is not good news, guys. This probably means high rates, worse economy, more pain to come. And just to take a quick look at how this bill is likely going to affect the deficits, we have a quick AI generated response. The big beautiful bill, in quotes of course, as it's called, is estimated to increase deficits by 1.1% of GDP through 2034 or 3.8 trillion. However, it says here 7% of GDP in fiscal year 2027. In the first year the policies are fully in effect, the deficit is projected to increase by 7% of GDP. Now, that is a massive amount to be increasing. A lot of estimates I'm seeing are estimating that we are going to start running deficits in this country above 6%, maybe even 7% of GDP every year moving forward in the future. And in the financial world, they consider any deficit for a country above 4% of GDP that's sustained to be a major red flag. So here we are in America running massive deficits that are just going to get bigger and bigger and bigger. And this is obviously going to create problems for the housing market, for the economy, and for foreign investors that are interested in potentially investing in our debt. And the last thing I want to cover for you guys is really for all those people that leave comments that think a lot of this stuff that I'm talking about is absurd and crazy and isn't really happening. So let's take a look at this house that sold in Oakland originally back in 2022 and then later again towards the middle end of 2024. So here you could see it's located in Oakland. This is on Redfin that I'm pulling this listing, and I'm going to go down here to where they show the price history for the property. And this is going to blow your mind. So this property originally sold March 3rd, 2022, and it sold for $4.1 million. Now, fast forward to May 10th, 2024, and look what you see here. It sold for $2,550,000. So this buyer essentially took about a $1.5 million loss, or almost a 40% loss, to get this property sold. So this really shows you the stark contrast between where we were in March 2022, where everything was pie in the sky, everybody thought real estate prices were going to go to the moon, and just a couple years later to get this property sold, this person had to aggressively cut the price to actually sell the property. So as you can see, we have a lot of things going on in the housing market and the economy. It's very important as a seller to be smart, to be strategic, to have a great agent that knows what they're doing helping you. If you need help with any real estate needs in SoCal, or you need a referral to a great knowledgeable agent in your area, reach out to me. My contact information is down below. I appreciate you guys watching, and I'll see you on the next video. Take care.